Good afternoon. Welcome to Kenya News Update today. I'm your host, and we're diving deep into a financial story with global implications that could reshape our technological future. For the next 12 minutes, we'll be examining why Alphabet's recent issuance of a 100-year sterling bond is raising alarm bells about a potentially dangerous, debt-fueled arms race. This isn't just about one company's balance sheet. It's about a multi-trillion-dollar gamble on artificial intelligence that could define the next century of economic power. We'll look at the staggering numbers, the human impact in places like Nigeria, where AI is already filling critical gaps, and the debate over whether this massive borrowing is visionary investment or reckless speculation. Let's begin. First, let's understand the scale of what just happened. Last week, Alphabet, the parent company of Google, made a landmark move in the bond markets. It issued a sterling-denominated bond with a maturity of 100 years. That's right, a bond that won't be paid back until the year 2026. This £1 billion century bond was part of a much larger multi-currency borrowing spree by the tech giant, totaling a staggering $20 billion in one go. To put that in perspective, $20 billion is roughly equivalent to the entire annual budget of a mid-sized African nation. This single fundraising event is a clear signal. The race to build artificial intelligence infrastructure has entered a new, hyper-capital-intensive phase. But why a 100-year bond, and why now? Financial strategists are calling this a classic sign of late-cycle exuberance, when investors, flush with cash and chasing yield, are willing to bet on the distant future of a company they believe will dominate for generations. It's a vote of confidence in Alphabet's longevity, but also a potentially risky bet in an uncertain world. This borrowing is not happening in a vacuum. Alphabet is just one player in what analysts are calling the AI Hyperscaler Club, a group of tech behemoths including Microsoft, Amazon, and Oracle, all engaged in a frantic spending race. The goal? To build the vast data center networks, secure the advanced semiconductor chips, and hire the elite engineering talent required to power the next generation of AI. This infrastructure is phenomenally expensive. We're talking about facilities that consume as much power as small cities, requiring billions in upfront capital. According to recent estimates, the collective capital expenditure, or CapEx, by these major tech firms on AI and cloud infrastructure could surpass $200 billion this year alone. That's a figure larger than the GDP of many countries. The debt is piling up to fund this expansion. Let's look at some key numbers. Microsoft has reportedly earmarked over $50 billion for AI-related CapEx in the coming years. Amazon's AWS cloud division is on a similar trajectory, and Oracle is making significant investments to catch up. But Alphabet's $20 billion bond issue, particularly the century-long sterling portion, stands out for its audacity and its symbolism. It's a bet that British pension funds and other long-term investors will still be collecting interest from Google long after everyone alive today is gone. Now, let's visualize the scale of this corporate debt mountain. The combined long-term debt of the major AI players has been climbing steeply. As of the latest quarterly reports, the total debt load for Alphabet, Microsoft, Amazon, and Oracle sits at approximately $185 billion. That's $185 billion in corporate IOUs. And this is just the debt on their balance sheets. It doesn't include the massive off-balance sheet commitments for data center leases and other infrastructure, which could add hundreds of billions more in future obligations. The concern among some economists and market watchers is that this represents a dangerous bubble. Companies are leveraging their strong credit ratings, often AA or AAA, to borrow historically large sums at relatively low interest rates, betting that AI will generate profits far into the future to pay it all back. But what if the AI revolution doesn't deliver the expected returns? What if the technology plateaus or regulatory hurdles emerge? The debt would remain, a massive anchor on these companies' finances. Furthermore, this corporate borrowing spree is happening alongside enormous government debt. The U.S. national debt, for instance, recently surpassed $35 trillion. When you combine soaring public debt with soaring corporate debt focused on a single, speculative technology sector, you create a system that is highly vulnerable to any shift in investor sentiment or economic downturn. But to understand the true stakes of this arms race, we need to look beyond the balance sheets and bond prospectuses. We need to see the human demand that is driving this investment. And for that, we travel to Nigeria. In Abuja, a young woman named Joy Adeboye represents a powerful, grassroots reason why companies like Alphabet are betting so heavily on AI facing relentless harassment from a stalker and unable to access or afford a qualified therapist, Joy turned to an AI chatbot for mental health support. At 2 a.m., when anxiety gripped her, the chatbot was there. It feels like someone's there, she told reporters. Across Nigeria and much of the developing world, AI is rushing in to fill vacuums in mental health care, education, and basic customer service. The demand is insatiable and immediate. People are using chatbots for advice, companionship, and crisis support. This creates a powerful narrative for the tech giants. The world needs our AI, and it needs it now. This real-world adoption justifies the breakneck spending on infrastructure to make these AI services faster, smarter, and more ubiquitous. However, this rapid deployment in sensitive areas like mental health comes with severe risks, amid calls for much tighter regulation. What happens when a flawed algorithm gives dangerous advice? Who is liable? The tech companies are building the infrastructure first and asking these ethical questions later, fueled by debt and competitive pressure. This brings us to the core debate. On one side are the optimists and the tech executives. They argue this spending is not a bubble, but a necessary foundation for the next industrial revolution. Sundar Pichai, CEO of Alphabet, has repeatedly stated that AI is the most profound technology humanity is working on, more profound than fire or electricity. From this perspective, borrowing $20 billion, or even $100 billion, is a prudent investment in a future where AI adds an estimated $15 trillion to the global economy. The Century Bond is a smart piece of financial engineering, locking in long-term capital at attractive rates for a transformative project. The debt, they say, is backed by some of the strongest cash flows in corporate history. Google's search business alone generates over $100 billion in annual revenue. They can afford the gamble. Furthermore, if they don't spend this money, their competitors will, and they risk becoming obsolete. In an arms race, you cannot afford to disarm. On the other side are the skeptics, including veteran investors and macroeconomists. They see alarming parallels with past debt-fueled booms that ended in busts: the dot-com bubble of the late 1990s, the housing bubble of the mid-2000s. They point out that much of the current AI spending is undifferentiated. Every company is building similar data centers, chasing the same capabilities, which could lead to a catastrophic overcapacity. They warn that the assumption of perpetually low interest rates that made century bonds attractive may not hold. If inflation resurges, the real value of that fixed interest debt could evaporate, and refinancing could become cripplingly expensive. Most importantly, they question the profitability timeline. While AI has captured the public imagination, its path to generating returns on a $200 billion annual investment is unclear. Will companies be able to charge enough for AI features to service this mountain of debt? Or is this a classic case of build it and they will come speculation, financed by the bond market? The fear is that when the cycle turns, the tech sector could face a brutal reckoning, dragging down pension funds and other investors who bought these long-dated bonds. The implications of this debt-fueled race extend far beyond Silicon Valley. It affects global capital allocation, energy policy, and geopolitics. The AI data center build-out is consuming a huge portion of the world's advanced semiconductor chips, straining supply chains and fueling tensions between the US and China. The energy demands are colossal, putting pressure on power grids and complicating climate goals. Furthermore, as these US-based tech giants consolidate power through massive infrastructure investments, it raises questions about digital sovereignty for other nations, including those in Africa and Europe. Will the AI future be controlled by a handful of deeply indebted American corporations? This concentration of power and financial risk is a concern for regulators worldwide. In Kenya, as we develop our own digital economy, we must watch this trend closely. The decisions made in the boardrooms of Alphabet and Microsoft will influence the cost, availability, and nature of the AI tools our businesses and citizens rely on. So, where does this leave us? We are at a pivotal moment. The issuance of a 100-year bond is a financial landmark that underscores both the extreme confidence and the extreme commitment in the AI future. The numbers are almost incomprehensible: $20 billion raised in a week, $185 billion in total debt among key players, and a potential $3 trillion total addressable market for AI that everyone is chasing. The human need, as seen in Nigeria, is real and urgent. But the financial risks are equally real. This is not a simple story of good versus bad. It's a story of monumental ambition financed by historic levels of debt. The coming years will reveal whether this was a masterstroke that built the foundation for a new age of prosperity or a debt-fueled frenzy that led to a spectacular waste of capital. One thing is certain: the stakes for the global economy have never been higher in the technology sector. The AI arms race is on, and it's being fought with bonds as much as with algorithms. Thank you for joining us for this deep dive. We'll continue to follow this story and its impact on global markets and local communities. For Kenya News Update Today, I'm your host. Subscribe to Kenya News Update Today for more in-depth reporting.